Hi, welcome to the Clear Financial Thinking monthly update to our Market Vulnerability Index, which attempts to answer the question, is now a good time to buy stocks? And so let's jump right in and answer that question. And the answer is it depends. If you're dollar cost averaging and you have a 20 or 30 year investment horizon or time period, yes, keep going. Don't change your strategy. Dollar cost averaging over long term periods works. It's been proven over and over again. If you're protecting a big retirement account or nest egg, and it looks like you're going to need to dip into that account over the next 5 years, 3 to 5 years, it's okay to be defensive because right now the market is very vulnerable and we're seeing lots of people take defensive positions. Just look at Warren Buffett. 65% of his investments are out of the stock market right now. So it's a fine thing to do at this point in time. If you're thinking about putting a big lump sum in the market today, maybe you inherited money or you just have a bunch of money that you've kept on the sidelines, I would pause a bit and look for short-term low-risk investments because we can find many of them right now returning a 4 or 4.5%, which I think is an okay place to be at this moment. Why do we say that? Well, it's because we look at a number of different inputs across 8 different categories, about 40 different metrics across 8 categories, and we come up with this index. And if you're interested in learning more about how it was created and how it works and what all those metrics are, there's a couple videos you can look at on our channel. One's Market Vulnerability Scorecard, and that was on June 3rd. And the other one was How Long Can the Market Stay Expensive? And that was on July 2nd. It goes into a lot of detail around this. But for now, just know that we back tested it. And we saw that the index did a pretty good job of showing vulnerability at key times in the history of the market, such as the dot-com peak, the pre-global financial crisis peak, the post-COVID peak where there was a lot of stimulus checks and quantitative easing that drove the market up and then it corrected. And so here we are again where the vulnerability is climbing. It's just climbing above 80 at the start of July. It was 80.8 when we ran it on this day. We ran it a few times late June and early July, and it was always in the 80s. And so that's a vulnerable period, and that's why I had those recommendations earlier on that investment slide. But what is the so here are the 8 components of the index, and you can see the top 4 are economic health, and then the bottom 4 are market pressures, and that some had positive impacts, some had negative impacts, but overall the risk increased by 0.9 in the month time frame of which this is doing the comparison. So let's look at that in a little bit more detail. What changed this month? Valuations remain stretched, so that increased vulnerability or risk. So the first 3 on this list, valuations, investor optimization, and speculation, are all related because the speculation and optimism are what's driving the increased valuations. So you can see forward PE is above 20, CAPE 40 plus, Buffett indicator 214%. If you want to know about all of those, we have videos on the channel describing each. You can look up and how they're measured, why they're important, and why they're useful. So it's very expensive time, but not as expensive as the dot-com peak. So there is a little bit of room if the optimism continues, but optimism and speculation can only go so far. We need, earnings to back that up. One thing, so those first 3 on this list increased the risk or the vulnerability. Liquidity stabilized a bit, so that decreased it. So M2 growth resumed. The Fed ended their quantitative tightening in late 2025, so the balance sheet stabilized a bit. There was more money in the economy for investing and growth, so that tends to lead to higher stock prices, which reduces vulnerability. That's a double-edged sword, though, and we'll talk about that more in just a sec. Inflation was relatively flat, but it's still above targets, keeping pressure on policy and limiting the chance of rate cuts. In fact, the chances of a rate increase later in the year is going up, And we'll learn more about that this month as we see the minutes from the latest Fed meeting, and also the Fed tends to share when they go to Jackson Hole later this month. But the labor market remains resilient. Unemployment stays in the low 4% range. So the strong labor market is helping reduce the risk or vulnerability. So a little bit more about liquidity. We were talking about that. In general, when the money supply is growing, banks are more willing to lend, stimulates the economy, helps drive stock prices up. So that decreases vulnerability. However, if we're in a situation like we are now, where inflation's higher than you want it, and speculation is high historically, adding more money to that can overjuice the stock market and lead to increased market risk. So you've heard the Fed say that liquidity is one of the levers they can use to try to slow down the economy if they don't want to raise interest rates. And of course, interest rates is a bigger and stronger lever, but it's interesting that money supply increased when inflation is high. I think that's something that over time, money supply, they will logically decrease to try to control inflation. If you want to know more about liquidity, there's prior videos on my channel about that. One is on May 15th. We talked about markets, why markets can stay expensive for so long. And then moving on, what to watch. So things coming up in July, we have the employment report in early August. We have CPI as normal, mid-August. We have corporate earnings. We have a lot of corporate earnings coming up. Just this week, in fact, we have on the 4th, Advanced Micro Devices, Caterpillar, Palantir Technology, SpaceX, Cloudflare. And then on the 5th, we have Duolingo, Airbnb. On the 6th, Microchip Technology. On the 6th, MP Materials on the 6th. So there's a whole bunch of earnings coming up this week, which will be interesting. And I expect a lot of those to be strong, and that they may actually decrease the vulnerability a little bit and increase speculation. And because that may drive the market even higher and pull the vulnerability up even higher, because the higher it gets, the more vulnerable it gets if the prices grow faster than earnings. And then Federal Reserve, as I mentioned, we'll see the minutes from their meeting last week, and we'll also see comments coming out of Jackson Hole later in the month. So that'll be interesting. So key takeaways. If the market vulnerability index follows historical patterns, a correction is coming in the next 11 months. And that's why I made the recommendations I did at the front of this presentation. Most likely cause is optimism runs out. The speculation is high, and at some point people get tired of chasing these what they think are going to be amazing earnings returns, and then especially in the AI area, and that if that does not meet expectations, valuations compress. So that's likely to happen, even if there isn't something big in the market, like if inflation stays under control and the job market stays healthy, that we can still see valuation compression. But if we see inflation climb, interest rates go up, decrease in consumer spending, that's when we're going to see a bigger reaction. So we're keeping an eye on all those things. Either way, I think there's going to be some compression, but it's just a question of how big it is. And so with that, thank you for watching. Next, we'll look at how to make good decisions regarding individual stock purchases. We have a tool that measures a lot of metrics related to individual companies and helps us decide whether it's a good investment or not. And please keep an eye out for that. We've already posted one video and we have more coming. Thank you.